Hello guys, in this knowledge module, we will learn about the currency options. And these currency options are similar to the stock options, but in case of the stock, the underlying asset is a stock. Over here, the underlying asset is a currency. So the currency option gives right to buy or sell the underlying currency at a given price, and the transaction will be conducted on the specific date. The difference between the forward and the option contract is that in case of forward contract, once you enter into a forward contract, that's an obligation, but the option contract is not an obligation. So if I'm buying the contract, the option contract, that is giving me the right whether to exercise my contract or not to exercise my contract. And we'll see and understand about it with our specific examples once we'll move ahead. So it is not the right, it is actually the right to buy the underlying currency at a specific rate if the market price of that currency is in our if it is not in our favor, then obviously we'll go and exercise the option contract. So there is no obligations once you enter into the option contract, which is unlike in case of the forward contracts, because in case of forward contracts, once you enter into the contract and upon the expiration of the contract, you have to settle the transaction. You cannot simply back off. Either you have to take the opposite position by selling that contract, but that's an obligation. But in case of the options, there is no obligation. It is simply giving the right to the buyer of the option contract. Now, there are two types of the option contract. One is the call option contract, and the other one is the put option contract. So this the call option contract, it gives the buyer of the contract the right to buy the underlying currency. So it gives the right to buy the underlying currency, which is not the case with the put option, because once you buy the put option, it gives the right to sell the underlying currency. So for example, in case of, let's suppose if you are you are American citizen, or your company is based in America, and you have imported certain things from any European country, and you have to pay that country, the exporter, in euros. So if you have to do this transaction next month where you'll need to pay the euros, you simply do not want to take a risk, and you may have to buy obviously the euros, and you want to be very sure that what would you want to pay in terms of dollars to buy that certain number of euros. Say if the euro payment which you have to make is 100,000, right? So you want to be sure in order to that how much units of US dollar you need to pay in order to get these, because you eventually have to make the payment to the exporter in euros. So in that case, you might enter into the option contract, and on the date of the transaction, you will see that what is the price of the euros in the foreign exchange market. If it is less, you might go and buy at from the euros from the exchange market, rather buying it from the call option contract seller who has sold the call option contract to you, which has given you the right to buy the specific, like in this case, the 100,000 euros. So it depends that what was the original contract, what was the strike price. Strike price is the price at which you basically agree to buy the euros by exchanging the US dollars. So let's suppose if the strike price is the euro 1.3 sorry, I'm doing it in other way. the euro in this case is a base currency. So if the strike price is 1.32 per euro, it means that you agree with the seller of the call option contract that you are ready to buy each euro by paying 1.32 dollars. So if you will be exercising this contract on the day of expiration, you need to pay 132,000 to buy 100,000 euro. Now, if in the exchange market this 132,000, if you have a chance to pay less than that, obviously you will not exercise the option and you will buy from the open market. For example, if in case of open market is 1.30 per euro, then why to exercise and pay for each euro 1.32? So you will be buying 100,000 euros by just paying $130,000, and this is how you will benefit, because it's a right to buy. You have the right whether to exercise the option or not to exercise the option. In this case, definitely you will not exercise the call option and you go with the market. But also remember, apart from the exercise price, which is also called the strike price, there is another component, which is the option premium. Like, if being a buyer of the option contract, you have the right, what is the benefit of the option seller? The seller of the option contract is actually will get right away the option premium from you. For example, in case if say there is in order to give you the right to buy each unit of euro, he's charging you the 1 cent, then this is your option option premium. So it means on a contract of 100,000 euros, what option premium you need to pay? 0.01 multiplied by 100,000. You will need to pay the upfront price of $1,000. So this is the price which you need to pay in order to buy the contract, and this is actually the benefit. Like this is the payment which the option contract seller will call option contract seller in this case will get from you. Now, what is the put option contract? In case of the put option contract, it gives you the right to sell. So for example, in this case, say now you are the exporter and you have exported the goods in euros, right? Not in dollar. Even if you are the US based company and you are sitting in USA, and it is very much possible that that you are invoicing in terms of euros. So if you are selling the things in euros and after a month you are expecting to get 100,000 euros. So 100,000 euros. Remember, your business is in US and all the salaries to your staff you need to pay, and other operating expenses you need to conduct in US dollars. So in that case, you want to be certain that after a month, which euros you are receiving, you need to get a certain price for that. Right now, if you see just after the presidential elections, I'm talking about the Joe Biden versus Trump elections, you see that there is a lot of pressure against on US dollars against all the currencies, and you want to be certain that whatever euros I will receive, right, there will be specific dollars I'll get. If this situation keep on continues where the US dollar will keep going down, might be you do not think to go and buy the option, the put option contract, and you will be simply getting 100,000 euros next month, and in the open exchange market you will basically sell your euros because your asset currency is euro, and if it will go or appreciate versus the US dollar, or in other words, if US dollar depreciate versus the euros, then you might not buy the right to sell the euros. So in other words, you will not buy the put contract, denominated in euros. But if you're not certain and you are doubting that might be this is just a temporary, the fluctuation of the prices of the US dollars versus euro, and eventually the US dollar will strengthen and the euros will depreciate. In that case, because your asset currency is in euro, and if it will depreciate, that is not good for you. So if today you want to enter into the put option, you want to buy the put option contract, you agree to sell your euros at certain strike price. Again, if this say that strike price is the $1.31 per euro, it means after a month, once you will exercise, if the market conditions are such, you will at least get $131,000, right? This is what you will be getting. But if on that day it turns out that the actual rate is 1.30 per dollar, so in this case, what you will do, you will obviously exercise the put option contract. In case of 1.33, will you exercise the option contract? If this is the price on the day of maturity of the contract, if this is the actual exchange rate between the euro and dollars, no, you will not exercise. In fact, you will go in the open market, sell your euros and get $133,000. So again, it is giving you the right to sell. And over here, why we are getting the right to sell, because we bought the put option contract. So this is sometimes for few students is confusing, that you bought the put contract, but that is actually giving you the right to sell rather buying anything, right? So this is the example about the option contract, put option contract. Now the currency option contract, they are traded both over the counter and in the exchange. So CME, which is Chicago Mercantile Exchange in US, the currency options contracts are traded. Now, whenever in case of call option, when the strike price is less than the spot rate, so it means that you can buy the underlying currency at a lower rate compared to the spot rate. In that case, you are in the money if you are the buyer of the options call option contract, and you are out of the money if the spot rate is less than strike price, because you can go into the open market and pay in the open market less price to buy the base currency compared to the strike price. The pay option profile of the put option contract is opposite. You are in the money if you bought the put option contract and the spot rate is less than the exercise price. If it is less, you can simply go to the seller of the put option contract and sell your underlying currency or the base currency at a higher rate rather what the market is offering you in the foreign exchange, rather what the foreign exchange market is offering you. And you are out of the money because you will not exercise the option if the spot rate in the foreign exchange market is more than the exercise price. So you will be able to sell the base currency at a high rate in the foreign exchange market and compared to what is the exercise price. So the same example with the euro, if you are selling your euros at 1.33 in the open market, why you will be willing to sell to the option contract seller at 1.31 and getting like 2 cents less. So if this is the exercise price and this is the spot price, obviously in that case you will not exercise your put option contract and you will be out of the money. So whenever you are out of the money zone, it means that you will not exercise the underlying option contract, and when you are in the money, right, you will be exercising the option contract. Now here is an example. If there is a the standard contract of the pound is 125,000, both for the put and call in the CME, which is Chicago Mercantile Exchange. And if the strike price or exercise price is $1.45 per pound, so in fact, maybe in this situation you are maybe the importer who eventually have to pay 125,000 pounds to the exporter of the goods from sitting in the UK. In that case, if you want to hedge your risk, and that's why you want to buy the call option contract, so this will give you the right to buy 125,000 pounds at the price of 1.45 per pound. Now, does not matter what would be the spot rate. This is the guaranteed rate at which you will be able to buy each pound, 1.45 pound, for $1.45 per pound. Now, if on the day of exchange, if the actual spot rate turns out to be 1.45, will you exercise the option? Yes, you will be exercising the option, because if you see over here, you can buy each pound by paying just $1.45. But in the spot market, it is $1.5 per pound. So why to buy at a higher price when you can buy at a lower price? So you will be buying 1.45. So I'm doing the calculation right now. 1.45 multiplied by 125,000. So it means 181,250 dollars you will pay to get 125,000 pound. And what is the saving over here? So the saving by exercising the option, it means you are in the money, but the saving is 5 cents per pound, if you see. So this is the $5 per pound is your saving. But there is some premium cost as well. What is that premium cost? Say if that premium cost which you eventually in the start paid was the 1 cent for each pound. So how much premium you actually paid? You simply multiply 0.015 with the contract size, which is in terms of pounds. So 125,000 multiplied by 0.05. So you paid actually the premium of 125,000, right? And what you actually saved from here, if you multiply 0.05 with 125,000, you actually saved how much? $6,250. But what is your net profit? Your net profit, remember, this is actually not minus. This is not minus, right? So this is your cost and this is your saving because of exercising the option. So your net profit is 6,250 minus 1,250. So your net profit is $5,000. $5,000. So this is how the contracts, the option contracts work. This is the payoff profile which I'm going to make. So if you see, this is the payoff profile of the call option buyer. So this is the payoff profile who will be going long with pound. So it's the call option buyer payoff profile. So this is call, and this is in terms of dollars pound, where pound is the base currency, and this is the spot rate at time t, and dollar pound, right? So now the payoff profile is something like this, and this is the in the money zone, in the money. Why this is in the money? Because let's suppose if this is the strike rate, $1.45 per pound. Again, pound is the base currency over here and price currency is the dollar. Then on the expiration date, or even it can be earlier, it depends whether it's a European or American contract. So if this if the spot rate is high, why you will be paying more spot rate, more US dollars to buy each unit of pound? So this is in the money and this is out of the money, right? Out of the money. So when you are out of the money, you do not exercise the buyer of the call option do not exercise the call option. So you will only exercise when it is somewhere over here, because this you do not want to buy the underlying pound at the higher rate, at the spot rate from the foreign exchange market, and you will go to the seller of the call option contract and buy each pound at a lower rate, which is 1.45, because that's the strike price or the exercise rate, right? For the call option seller, the payoff profile is something like this. So whatever is the gain of the call option buyer, that's actually the loss of the call option seller. So in the money and out of the money, right? And again the same thing, it's actually dollar per pound, and this is the spot rate, right? Over here in the x-axis, spot rate dollar pound. So the call option seller want the spot rate below this area. Remember, this is the strike price zone. This is the strike price level, 1.45 per pound. So the call option seller wants the spot rate to be less than this, so that the call option buyer must not exercise the money, exercise the option. So if it is the spot rate is less, he will not exercise, it will remain out of the money for him, and that's actually what his gain, the option premium, which the call option seller already has gotten. And when whatever is the gain of the call option buyer, that's actually the loss of the call option seller. Now in case of the put options, right, the payoff profile is something like this. So this is for the buyer of the put option contract, put option, and this is again dollars pound, where pound is the base currency, and over here you have the spot rate at time t, dollar this. So this t is just representing that it can be any time. And if the strike price is, I'm going with the same strike price example, 1.45 per pound, then if this is the level of 1.45, anything on the left hand side, the buyer of the put option contract is in the money, So in the FX market, if the rate is below that, remember this is the rate is going lower over here. So if the rate is lower than 1.45 for each pound, he has the right to sell each pound at 1.45, but he will remain out of the money, means he will not exercise the option, he will be out of money, he will not exercise the option if the rate will be above 1.45, say $1.47 per pound. Obviously that will be somewhere on the right of 1.45. And why he should go and sell his each pound at 1.45 to the call option contract seller, when he can get against each pound 1.47, so 2 cents, why should he forego? So he'll go into the open market and he will not exercise the call option. And obviously there is an opposite profile for the seller of the put option contract. I'm not labeling in detail. Again, this is dollar pound, this is ST, spot rate at time T, dollar, pound, where pound is the base currency. And if we'll do it like this, so it will be something like this. From this point, if this is dollar 1.47 per pound, so that's like his profile will be opposite, his direction will be opposite of the line. In the money for the call option contract buyer, and this is out of money. So being a seller of any option contract, you want the buyer to remain out of money so that he will not exercise, because when he will exercise, obviously the market conditions are not in his favor, and he will get the benefit by exercising the option, and whatever benefit or gain he'll get, that's actually the loss of the option call or put option contract seller. Yes, contract seller who is selling the contract. Now in this case, again, it like this is the continuation of my previous lecture. In fact, not the previous lecture, which I was just mentioning on the few previous slides, that the the option, because it gives you the right to exercise, so it acts as the insurance. So if the market conditions are not in your favor, obviously you will exercise, and exercising means that it turns out to be insurance, and it's in your favor if you are the buyer of the option contract. This is another illustration. You should pause the video and first look over here that what is the data given to you. So obviously on the options we need to pay the premium. Now the example is, let's suppose that if you want to buy the 100,000 Australian dollar in December, the options usually expire on the third Friday of each month. If it is expiring on the third Friday of each month, which is 18th December 2020, because we are sitting in the year 2020 and December is the next month. And so let's suppose if you are the importer of the of some Australian product, and you need to pay in 100,000 Australian dollar on 18 December 2020, and you want to buy the contract, the call option contract, because it will give you the right to buy the underlying currency, which is the Australian dollar. And why it's Australian dollar 100,000? Because this is the standardized contract size of the option contract on the CME, and the rate is Australian dollar December 6400 call, selling at the price of this 0.012 per Australian dollar. So what is the base currency? Your base currency is Australian dollar, and your price currency is US dollar, right? And this will give you the right to buy the Australian dollars of 100,000. So one option contract is giving you the right to buy 100,000 units of the Australian dollar on the Chicago Mercantile Exchange, which will be expiring on 18 December 2020. And this is the strike price. What does it mean by strike price? It actually means that each Australian dollar you will be able to buy at the US dollars 0.6400. So we will move the 4 decimals over here, and this is the strike price, where Australian dollar is the base currency. Remember, this is the mathematical way of writing the exchange rate. In real, you know, when in the exchange rate, when the you can write it as a the spot rate. But remember, okay, ignore it over here. We'll see on the next slide that how we will write the spot rate when it is quoted in the spot market. Now, what is the premium cost? The premium cost is $1,200. Why? You multiply 0.0120 with the contract size. So if you will multiply this thing with the 100,000, which is the contract size the Australian dollar call option contract on CME, then you will get this much the premium cost. So this is the premium cost. Once you pay that, now you have the right to buy Australian dollar 100,000, and that right will expire on 18th December, because that will be the third Friday in the year 2020 when the call option contract will expire. Obviously, if you will be receiving the Australian dollar, you need to buy Australian dollar in order to pay the exporter. If your position is opposite, where somehow you are the exporter and you generated the invoice in Australian dollar even by sitting in USA, in that case you will be receiving maybe the Australian dollar, obviously the Australian dollar, so you need to sell your Australian dollar. In that case, you need to buy the put option contract. But in this case, because we are assuming that you are the importer and you need to pay the exporter in the Australian dollar, and you are the US company, so you need the right to buy the 100,000 US dollar, and that right you will get only by buying the call option contract. Now here are the details that what could be the under the different scenarios, what is your possible profit and loss. Now this is the strike price, right? That in order to buy 1 Australian dollar, you have the right to buy, because you paid the premium of $1,200 US dollars, and this gave you the right to buy each dollar Australian dollar by paying the 64 cents of US dollars. Now if on the 18th December, when you needed that 100,000 Australian dollar, if this is the spot rate, will you exercise your call option contract? You will not exercise, because in the exchange market you can get each Australian dollar at a low rate, which is 0.628 over here. Remember, this is how the things are quoted in the exchange market. In the mathematical way, this is the same as 0.628 per Australian dollar, right? Thus, in the first scenario, there is a loss of 1,200, because the premium is already been paid. The person will not exercise the price, and obviously has done this much loss. In the second scenario, when the spot rate is equal to the strike rate, again he might not exercise the contract, because at the same rate he can get the Australian dollars from the foreign exchange market. So again, this is the loss. In the third scenario, now he will be in the money. From here onwards, in all these 4 scenarios, 1, 2, 3, and 4, he is in the money, and he will exercise the call option contract. So the premium is again paid. Now he will pay 64,000 to buy US dollars to buy 100,000 Australian dollars, and he can sell the same 64,000 in the open market for 64,500. So if you see that here, he will have $500 US dollar profit, right? But what is the net profit? The difference between the 1,200 and 700. So he actually saved 500. Even if he will not sell the 100,000 US dollar, because we assume that he was the exporter, so he might simply pay the exercise price and will not sell it. But eventually the final effect or the impact, the saving impact he will be having is net profit of the minus 700. So again, he has done the loss, because his profit was 500, but his cost was 1,200. So net loss is actually 700. Now here, in fact, he will be making, if you see all this calculation, you will see that he just had made the break even, and his net profit is 0. In these last two cases, in the last two columns, he has the situation where his net profit is 1,200 and 12,000 respectively. So if you simply pause the video and carefully watch over here, you will find that under the different circumstances, how he will end up getting benefit from exercising the option, and when he's not exercising the option, especially in these two conditions, he definitely have a loss. But even if he will exercise the option, might be he will reduce his cost but totally not eliminate the cost, like what has happened in this column. But in the last three column, at least in the third last, he made the break even, and in the last two, definitely he actually made the profit by exercising the call option contract. Thank you.